Today's episode is sponsored by Saxo, the platform bringing you a premium investment experience without the premium price tag. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Copper is integral to the global economy, and its importance will only increase as the world decarbonises its energy infrastructure. Bulls have long argued that supply will fail to keep up with rising demand, driving copper prices higher.
So why have prices slumped in recent months? And in today's dumb question of the week, who is Dr. Copper? All right, let's get into it. Copper is critical to the economy and a key component of electrical infrastructure and products, and more importantly, a key component of your market crash shopping list, Roman.
Yep, I recently made a video about this, and I definitely am interested in copper, simply because at the moment the price is really tanking. So you've got this situation where there's a structural, long-term reason why copper's going to rise, and at the same time you've got constrained supply. So I think that's a pretty good recipe for a market crash shopping list entry.
Would you say you've been seduced by a supercycle narrative, Roman?
Well, I was previously, and I made good money out of it. But so I think that's a narrative which I've been sucked into and out of already once. But this isn't really about a supercycle narrative. It's specifically about copper, and copper's quite special. So here a background in physics kind of helps, because copper's got very low resistivity. In other words, it's very conductive. And it's very difficult to substitute copper with some other element because it has this amazing property.
Am I right in saying that only silver is more conductive when it comes to metals?
Yeah, unfortunately, silver's quite expensive. So you can use silver or maybe even gold if you buy really fancy headphones. People do. But clearly, if you've got an offshore wind turbine, plumbing it into the electrical grid with gold cables is not going to be very cost effective.
And as I understand it, it's not just the fact that copper's great at conducting electricity, which makes it special. It's also easily stretched and shaped and is resistant to corrosion. So it's kind of the perfect metal, isn't it, for plumbing in the electrics of the world.
And we've had a really long history of using copper. It was one of the first elements that was used to make weapons. And for humans, it's been very much part of our technological development.
The Bronze Age was kind of the copper age, really, wasn't it? You just mixed it with a bit of zinc. And zinc got way too much credit for that age. It's copper, really.
And then smelting, it was one of the first things that got smelted in order to refine it. And so I think overall, copper's a kind of very special metal, and I love it. So if we're going to move to this new age where we're less reliant on things like fossil fuels, we're going to need a lot of it.
So the energy transition, which is what you're hinting at there, is basically the electrification of everything. So our cars are going to stop being combustion engines over time and are going to be EVs. That transition's underway now. Also, our energy infrastructure. So we're going to hopefully move away from dirty coal and oil and onto things like solar cells, wind farms, and batteries. And the copper intensity of those technologies is much higher than the infrastructure they'll be replacing.
Yeah, so just take cars, for example. If you go from an internal combustion engine car, an ICE car, and compare that with an electric car, the electric car will use about twice as much copper, about 80 kilograms of copper in an electric vehicle versus about 40 in an internal combustion engine car.
And is that primarily because of the battery?
A battery has a lot of it. So it could be the case that the battery chemistry changes over time to be less dependent on copper. But it still requires copper for other components within the car, obviously, because you have to move the stuff around inside the car, the electricity. The other thing that's kind of interesting is when we moved out of our old house, which we rented in Amersham, it was interesting. The guy who was our landlord, this lovely young guy called Andy, his specialty was as an energy engineer. So he kind of knew all about this stuff. And he was completely taking out the gas requirements. And everything was going to be electric, the heating, everything about the house. I thought that was really radical, but thinking about it, I can see that that's going to happen to a lot of houses. For example, we got rid of our gas cooker. And so the only thing we use gas for now is the heating. So I think if you move to things like heat pumps, then yeah, it's very easy to see a future in which you don't need a gas supply at all.
And just going back to transport, it's not just the cars themselves or the trucks, which are obviously going to use huge amounts of copper. It's the charging infrastructure as well.
Yeah, so you have to have these charging points and you have to have those connected to the grid. There's all sorts of secondary implications, secondary effects of having this EV charging infrastructure. And all of that relies on copper.
And at the same time, we're obviously changing our electricity generation. And the things we're moving into, as we mentioned, wind, solar, tidal, they all use a lot of copper. And demand is expected to rise hugely. So there's some good research by S&P Global, which looked at the amount of copper you need to generate a megawatt of electricity. And offshore wind is actually the most copper intensive. We need almost 5 metric tons of copper to generate 1 megawatt. But also things like solar cells is 2.3 tons, and tidal power is right up there, 3.9 tons. That's huge compared to where we were with fossil fuels. Now, obviously, there's a reason we're moving away from fossil fuels. The planet's getting warmer, but it puts a lot of strain on copper supply.
Yeah, I thought what was interesting about that report was that it was talking about a crunch point when there's the maximum difference between the demand, increased demand for copper, and the supply. And they expect that in the middle of this decade, which isn't far away, right? It's just a year away. So I think in 2025, the disparity between the two is really going to start to become very marked. So as we are seeing the price of copper fall quite sharply recently, I think that tees us up nicely, if this story's true, for a rebound in copper.
But given everything we've just said about what looks like a structural imbalance, we're going to need a lot more copper. Why is the price falling?
It's interesting. If you look at the price of copper versus Chinese growth, there's an incredibly strong correlation. In fact, some people use this to try and back out the true rate of growth in China. Because strangely, some people don't trust the figures that come out of China. I can't understand why.
I am one of those people. We've had this argument before. You're more trusting of Beijing than I am.
But sometimes there is a disparity. And maybe it's because Chinese growth is less copper dependent now, because there's less dependence on the building industry. But certainly it's true that if Chinese growth weakens, then the price of copper usually falls as well. And that's because it buys about 60% of the global supply of copper every year.
Yeah, it does dominate copper consumption. Europe's something like 15% of the consumption and the US just 7%. And if we look at what's happened to the price of copper this year, so there was a big run up and it peaked in May. And since then, copper prices have fallen by more than 20%. So we are in technical correction territory for fans of market jargon, but still up year to date.
Now, we've just had the third Chinese plenum when they set out their long-term plans for the country. And they do make these long-term plans and usually keep to them. And one of the things that surprised people in a negative way was that there isn't going to be a stimulus for growth. So that tends to suggest that if they're not going to support the building industry, then there's going to be a weakness in demand for copper. So that overall has painted a negative picture. Plus, there's been a weakness in demand for EVs. That's been all over the headlines. So all of that combined paints a short-term negative picture, I think.
China watchers have long hoped for this kind of big bang in fiscal policy, haven't they? Where the government maybe starts to build a proper welfare state to support incomes and tries to boost domestic demand. And we're just not really seeing that from Beijing. They're still focused on building out infrastructure and subsidizing assets to some degree. I think what I've seen is that Xi Jinping is pretty skeptical of this Western model of welfarism, as he might call it. It makes the Westerners lazy, that kind of thing. Maybe it does, but it's good for the economy. So we just haven't seen that. And I think monetary policy is going to have to step up. I've already seen that the People's Bank of China has started to trim some of the key interest rates just slightly.
I think that surprised markets. And overall, I think their policy's been a good one, which is they've tried to get ahead of the game. They've looked at the trends in society, which is a move to renewables. And they've basically cornered the market for copper. So China alone in 2020 accounted for over 40% of the refined copper produced globally. And yet, if you look at the West, they haven't identified copper as a critical element, which is very odd, given the plans for energy transition.
We've allowed China to corner the smelting market. Why is smelting market a funny term? I don't know. It just is, isn't it? But if you wanted to paint a super simplified picture of the global copper supply, it's mined in South America, shipped to China to be refined. A lot of it's then used in China and some is sent back to the West and to India.
Yeah, that's fair. Chile and Peru, they account for about 38% of world production.
And it is a very concentrated market, much more so than oil even, for example.
Yeah, which is interesting because if one of the mines does shut down for whatever reason, it's going to really squeeze supply. So again, I think this could create short-term surges in the price of copper. So if you wanted to get out, if this did pan out as a story, you could during one of those surges. But I think this is one which is probably worth holding for some period of time.
But as we've said, the short-term fall seems to be a story of demand and market expectations that China's growth is going to be weaker than expected. So their latest GDP figures, which are for the second quarter, came in at the slowest pace in more than a year.
And that's what they admitted to, presumably.
Yeah, they were showing an expansion of 4.7%, which is below their official target of 5%. So what it is in reality, who knows? But the copper price, if we take that as a signal, is saying Chinese growth is not great right now. And that's also showed through in the retail sales figures. Again, official statistics, which are showing that consumers are reluctant to spend. And we've got deflation, which has now been going on for more than a year.
And if you look at copper stockpiles in China, that's a key thing to watch. That's really shown a big build-up. Because if you don't use it, the inventory just builds up.
Just sits in the ports, doesn't it?
Yeah, and that pushes down the price, of course.
So there's the biggest stockpile of copper supply in Shanghai since 2015, if you exclude the sort of start of the pandemic where everything was shut down and supplies piled up everywhere. But not just in China, actually, because they've been using less of it domestically than expected. They've been sending more of it overseas, and stockpiles at the London Metal Exchange have doubled over the last couple of months. So short term, this sort of bull story doesn't seem to be playing out. Demand is underwhelming, and there's a little bit of a supply glut right now.
Now, with all these price series, it's always good to zoom out and see where you stand right now compared to long-term history. And at the moment, we're well above the average price if you look over the period since 2000. So the price of copper per metric ton in US dollars had an average of around maybe $5,500. Currently, we're at about $9,000 as we make this podcast. But really, the surge in the price of copper was around the year 2005, 2006. And it hasn't fallen a huge amount by then. It's been very volatile, of course. Commodities usually are.
Yeah, in real terms, we're below the peak from 2008, which was kind of the heart of the Chinese commodity boom as they were massively ramping up construction of housing and infrastructure. And if you translated it into today's money, that would have been a peak of around $14,000 per ton.
Yeah, so not so bearish as you'd expect if you zoom out and look at the longer term history. But still, over the short term, there is a weakness.
But over the long term, as we've said, it looks like demand has to go up massively if the world is going to meet its net zero target, which is set for 2050. This is why it's on your market crash shopping list.
Yeah, exactly. I think we could crash further, given that long-term history. You know, I wouldn't be surprised if we did see it fall to below 8,000, 5,000, something like that. But I'd start building my position sooner, I think.
So your market crash shopping list, Roman, as far as I can see it, looks like a kind of grab bag of all these sort of investment narratives, which may play out in the long term. And you're sort of saying, this is my fund portfolio in waiting. Like one day, if the price looks juicy, I'm going to jump on the train. And copper is one of those things. And I'm just interested, like, when did it get onto that market crash shopping list?
Well, remember the market crash shopping list is part of my fund portfolio. And think of the main portfolio as a really boring thing with iron discipline, where I'm really careful about risk, diversification. It's just got one fund in it.
Right. And the fund portfolio is something with copper discipline.
Well, you know, it's like a toddler in a sweet shop. You know, I can do whatever I want, so I have fun. You know?
Yeah. You read analyst reports and it goes, is that right?
Yeah.
So when did copper make the cut?
Well, that was literally a few weeks ago. It's been something I've been reading about for a long time. I look at Javier Blas, I look at his articles in Bloomberg, and they're very good. Also, I kind of monitor things to do with electric cars. I'm kind of obsessed with them. The energy transition story is a fascinating one, and it's something I've been following for a long time. So why not invest? Fund portfolio, buy stuff that's to do with that transition.
I think the moment that really kicked off the bull narrative or popularized it was this report from S&P Global in 2022, The Future of Copper. And that tried to model that if the world is going to hit its net zero targets, what technologies are we going to need? And then for each of those technologies, what will the demand be? So EVs, how many are we going to need? What copper are they going to use? What does that imply for demand? Same thing for solar and wind and all the other energy supplies. Same thing for the grid, all that stuff. And then they totaled it all up and said that copper consumption should double from the present 25 million tons annually to around 50 million tons by 2035. And that would mean it's very difficult for the world's mining supply to meet that demand.
Yeah, and that's a big jump from where we are now. So it's assuming that there's going to be this smooth transition to a new source of energy, and lots of people will go out and buy electric cars, which I know isn't true necessarily in all countries. Certain countries have really jumped ahead of the game. If you look at Norway, for example, which is one of the biggest producers of fossil fuels globally, they're also one of the biggest adopters of EVs. Whereas if you look at the US, there's a huge, almost cultural hatred of electric cars. So I don't think it's going to be a smooth transition.
I think it's unfair to say that the report's expecting a smooth transition. If you read through it, they're very much like, this is predicated on the basis that we are going to hit it. But these are all the reasons we might not, one of which is the fact that we just might not have enough copper.
To be fair, they do look at two scenarios. One they call high ambition, the other one they call rocky road. And they say the name high ambition is in the spirit of the oft-repeated phrase that greater ambition is needed to achieve 2050 goals. Rocky road reflects all the challenges along the road, from excavating rock to finished copper product. Both scenarios make clear that it'll be extremely difficult to deliver that scale of supply over the time frame.
Yeah, the high ambition scenario is basically saying we improve our ability to recycle copper from products which we no longer need, and we lower the copper intensity of technologies through innovation. Whereas Rocky Road is basically saying we don't get any better at recycling and we keep jamming as much copper as we need in everything. Now, the models for both these scenarios show a shortfall by 2035, but it's particularly pronounced in the Rocky Road scenario, where the shortfall is around 10 million tons per year of copper, which would mean around a 20% supply deficit. Now, that would have a big effect on the copper price, were it to happen.
But I think what's pretty worrying is if you read their report, they talk about copper mines gradually producing lower quality ore over time, which is a trend that we've seen, and a huge difficulty in getting new mines online because of environmental concerns, things about the use of water, because you need quite a lot of water to refine the copper.
And there's ongoing droughts in places like Chile, which are so important to global copper supply.
So the thing is, do you want to starve the local communities of the water supply and use that to mine copper? And the answer is obviously no. Nobody in Chile is going to agree to that.
And the point about lower grade ores is actually an interesting one. So today's copper mines typically contain only about 1% or less copper in their ores. Whereas if you go back to sort of the start of the Industrial Revolution, it would be more like 5 or even 10% copper in the ore that was being mined. That's a big difference. Now, obviously, we've got better at the technology and getting that copper out, but it's expensive and uses a lot of water.
And as you exhaust the mines close to the surface, you have to dig deeper. And all of that comes with increased costs. So if there was a substitute, I think people would go for it at a certain point when the price reaches a certain point. But I think this difficulty about substituting another element is a really important one.
And the thing to understand is that copper is not rare. There's loads of copper on the earth. It's just not always easy to get at. And it's a dirty process with lots of roadblocks. So, in fact, this report says that on average, the time taken from discovering a copper deposit to actually getting the mine operational is more than 16 years.
So I think it's fair to summarise the report in terms of supply by saying that it paints a fairly challenging story.
Oh yeah, definitely. Based on their demand projections, they say you'd need to open 3 tier 1 mines every year for the next 29 years to keep up with that growing demand. Now, I'm not an expert on copper, but tier 1 makes them sound big. They're expected to produce 300,000 metric tons of copper per year, each of those mines. And this is where they come to this conclusion that there could well be a 20% deficit in the next 20 years.
Today's episode is sponsored by Saxo, the platform bringing you a premium investment experience without the premium price tag. As all good investors know, nobody can control what happens in the markets, but one thing they can control is their costs. That's why Saxo has lowered their prices so you can grow your wealth and more of your money stays right where it belongs, with you. Search Saxo, invest for less. Now, when there is demand for a particular commodity and there's a clamour for it across the world and it comes in limited supply, it usually leads to war. If not a shooting war, then certainly a trade war. And there's already a huge amount of ill will between the US and China. So I think this could just exacerbate that problem.
And remember that the US depends on imports for, more than half of its copper supply. And as we said, China is by far the world's biggest smelting nation.
So you could see a scenario in which the US is trying to starve China of technology for things like chips. And at the same time, China could say, look, we've got control over these raw materials. We'll starve you of your copper supply.
Yep, and I think the tension would only ramp up if copper prices do surge, as this report suggests they might over the long term.
Now, I'd be the first person to criticise the accuracy of forecasts from strategists and brokers, because I was one, so I know that it is finger-in-the-air stuff. Do you believe it?
I mean, that does all hinge on the projections of the report, right? Which is primarily around demand. And the big assumption is that the world will reach net zero by 2050, or at least pursue a course which it thinks is going to get there. And I don't know, we don't see that at the moment, right? Most of it is kind of vague promises about overhauling infrastructure. If you're a copper bull, you have to believe those vague promises will become actual policy. And the other thing, I think, is that you have to be a bit of a technological pessimist to think that prices of copper could, go up 4 or 5 times and we wouldn't find a way to dramatically reduce how much we need to electrify the grid and things like that, or that we couldn't develop reasonable substitutes. You're the physicist here, so I'm not going to say whether that's possible or not, but you have to believe it isn't possible. And also you kind of have to be a market pessimist around incentives to think that the copper price could surge hugely and that wouldn't incentivize us to sort of overwrite ESG concerns and water concerns and just build a load of mines quickly. I'm not saying those 3 things couldn't happen, but it does seem a big assumption.
I think the one that would really put a dent into this story and completely reverse it is if we did invent high-temperature superconductors, because suddenly you wouldn't rely on copper to pipe energy from A to B. In fact, you could send it with zero conductivity loss over huge distances. Immediately, that would transform where energy is produced and consumed. For example, the UK could pipe in energy from places where it's sunny to places where it's not, like the UK.
I mean, there's been these rumours over the last couple of years, usually coming out of Chinese universities, where they show tiny specks of metal floating and everyone goes, wow, they've done it, room temperature superconductors. And then it turns out that doesn't quite add up.
But if it did happen, and I mean, you can see why there's so much focus on it, because if it did happen, not many technological innovations that you see would be truly transformative. I think this would possibly be the biggest one of this century if they did discover superconductors. So if they did, I'd immediately short copper, because suddenly the story completely implodes.
Unless the superconductor needed copper, I guess.
Yeah, I mean, they often do. So previous high-temperature superconductors, they're not very high temperature. They're just very, very cold superconductors. They often require copper.
The other thing, which I think may be underplayed here, is our ability to recycle copper. Currently, recycled supply accounts for around 17% of refined copper each year. I could see that rising dramatically, especially with the mass adoption of EVs, because those batteries have a shelf life. And when they're done, you just take it out of the car, right? And you've got a big lump of copper that can be easily recycled. At the moment, it's hard to recycle stuff because, well, one, we're still using copper. They're in products with a really long lifespan. but also it's sort of, in walls and tiny bits of electronics. Whereas if we just have big batteries, which we can take out at the end of their life, surely we can get that 17% figure way up. And that kind of underpins the high ambition scenario from that S&P Global report, where they would say that if we got much better at recycling, that 10,000 ton supply deficit in 2035 would shrink to less than 2,000 tons. It would go a long way to solving our copper needs.
And as the price rises, there's a bigger incentive to recycle copper. So I could see that the supply from that source would increase. So I think the devil's really in the details of how much demand increases and how much supply could increase to meet that increased demand.
Because you see the question often posed as, is copper the new oil, right? That's the cliche.
Yeah.
And I think you have to say, no, it's not the new oil. Even if there are some things which look similar, you've got geographical concentration, it's politically important, it's going to power the economy. Those things are similar to oil. However, oil is consumed all the time. You put it in your car or your plane and you burn it and it can't be used again. Whereas copper can be recycled. And also once you incorporate it into a product or infrastructure, it's going to be used for a long period of time. So whereas oil demand is continually there, copper demand might just be this one-off thing over the next couple of decades while we electrify everything, and then maybe it'll fade away.
Yep, that's absolutely true. But of course, I'll be dead by then. So for me, the fund portfolio trade is very much focused on this kind of transition period and the battle between supply and demand.
So Roman, you seem itching to buy it. How are you going to get exposure to copper?
A couple of ways. I think one of them is direct exposure via futures. Now, I can't buy futures myself as a UK retail investor. I can buy an ETF or an ETC, as they're called, exchange traded commodity, which gives me that exposure. I'd buy it in sterling terms. There are funds which offer that because then I won't have to pay the FX conversion fee. So I think that's probably the way I'd do it, directly. And then indirectly, there are various copper mining companies around the world which will benefit from a higher copper price, some more pure than others.
And I guess theoretically, the copper miners would be a decent way to play this because obviously they benefit from the price going up, but they also have a kind of risk premium in there, which is not so present in the commodity trade directly.
Yeah, that's right. I think you get paid a fat dividend while you wait if you're wrong, which is kind of nice. And then you get the upside if you're right. So I think that's a reasonable way to play it. And the names here would be companies like Rio Tinto, Freeport McMoran, Southern Copper, Glencore, BHP, Antofagasta. All of those, to some extent, benefit from the rising price of copper. The ones which do so best are probably Southern Copper, Freeport McMoran, and Antofagasta. And the way I worked that out was to look at the correlation of their share price with the copper price. But look, these are not share tips. We just don't do that. And we don't talk about share tips because we'd get it wrong. So if you want copper exposure, that's probably a reasonable way to get it. But look, not a recommendation.
I think the miners do have challenges, though. They're often in very politically sensitive countries in South America, which are unstable in some ways, both exposed to earthquakes, a lot of those mines, and labor disputes, and just having their mine taken off them could happen. So, it's a challenging sector to work in.
Yeah, so look, there are risks around this play, and it is a play, and it's not likely to pay off. So, that's why I put it in my fund portfolio. But it's something which I love because it ticks all of the boxes for a fund portfolio. I'm engaged with the narrative, all the bad stuff that goes with that. But it's fun, and I kind of like it. I read news stories about it. So that's why I'm going to be watching this one pretty closely. And anyway, I'll probably talk about it on my YouTube channel if I do something about it. But whatever you do, don't copy what I do because I'm almost always wrong.
My fund portfolio has one trade in it. Short your fund portfolio.
Jim Cramer. Yeah, that's what I am. Now, you might think that in the PensionCraft community, we spend a lot of time talking about our core investments and index funds. We certainly spend some time doing that. But no, we spend a lot of time talking about these crazy fun portfolio ideas. So why not throw your hat in the ring, join us, just go to pensioncraft.com/membership.
Okay, today's dumb question of the week is, who is Dr. Copper? Now, from everything you've said today, I have a sneaking suspicion you're Dr. Copper.
If only. But people talk about copper as a really good indicator for the global economy. If its price goes up, that's usually bullish for the economy because it's used for so many industrial purposes. Whereas if the price goes down, that paints a fairly negative picture.
So they say it has a PhD in economics and is a leading indicator, isn't it? It can tell you where the economy's going to go in the next 6 to 12 months.
Yeah, who needs an army of strategists when you can just look at this single price and figure out what's going on?
But does it work? It seems too good to be true.
It certainly works for China. It does correlate very strongly with its GDP. Maybe less so in future, as China becomes less commodity intensive, its growth.
But even if it does become less intensively used in China, it still will be the world's biggest copper consumer, probably, for the decades to come. So at the moment, the top 5 countries for copper consumption are China and the US, obviously, but then also Germany, Japan, and South Korea. Whereas by 2050, that's projected to change to still be China and the US, but also India, Vietnam, and Mexico. So you've got those developing and industrializing countries replacing Germany, Japan, and Korea. But still, China's going to be there.
Yeah, so the growth baton may be passed on to other countries, but you still need copper to build stuff. You need to put it in your buildings, in your cars.
And if a lot of the global growth is going to come from those industrializing economies, then maybe copper will still be a good indicator. And if copper prices aren't going up, then maybe they're not industrializing as fast as we hoped.
So it's not going to lose its PhD, I don't think, anytime soon. I still think it's worthwhile watching.
But earlier we said that copper prices have fallen 20% in the last couple of months. Is the doctor saying the global economy might be coming down with the flu?
I think so. If you look at US growth, if you look at certain indicators like employment data, it is showing some weakening. So perhaps the doctor's right again.
Would that have implications for assets if growth were to disappoint?
Yeah, I mean, risk assets generally do best if there's a period of good growth. If there is a pullback in growth, then that would be bad for risky assets like stocks, commodities, and a better story for things like fixed income, bonds, and safe haven assets like gold.
Because the implication is central banks may be forced to cut rates.
Yeah, and cutting rates for bad reasons, which is poorer growth.
So let's see if the doctor's right. Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.